Good morning. Welcome to the Spear REIT Limited FY21 results presentation. At the start of this morning's presentation, I would like to extend our warmest wishes to the Muslim community as they observe Eid today after the month of Ramadan. Today's presentation will highlight some key insights as to how Spear has successfully navigated the year within the operating context of the COVID-19 pandemic and its residual effects. I will furthermore also talk to what lies ahead for the company in the coming year. I'm in the fortunate position to present the results today due to the fortitude and tenacity of our tenants, our team, and our high-quality portfolio. The values and goals of Spear have shone through during the last year, which have been focus, commitment, resilience, generosity, and business continuity. Globally, the pandemic has been one of the greatest plot twists of our generation, causing the acceleration of the digital universe on the one hand and the deceleration of the physical world on the other. The rate of the economic recovery from the pandemic will vary from region to region, but the most common denominator that will be a guiding beacon for our recovery will be the successful rollout of a vaccine with a high efficacy rate. It would, however, be a blunder to use the deepest dip in real estate demand as the new benchmark for global real estate needs going forward. The operating environment throughout the year was unpredictable and full of uncertainties, as the government-imposed lockdown took effect and two infection waves took place. Throughout the year, management operated at close quarters with our tenants, stakeholders and funders in order to ensure business continuity and quick turnaround times. The result of this is evident in today's presentation. Our view remains that real estate is the business of local markets. We maintain that the Western Cape is the investment case for South Africa. Now, we love the entire of South Africa, but there is nothing quite like the Western Cape ticking all the investment box as well as an immaculate location. The human and healthcare response launched by the national and provincial government departments must be recognised and appreciated. I would like to take this opportunity to thank and appreciate all the frontline and healthcare workers for their tireless efforts over the past year and going forward. A recurring theme during the year was that the need to consistently be able to adapt at short notice to the operating environment and forge ahead as best possible. We did just that. We were always at the ready. Certain parts of the real estate sector and the general economy continue to be negatively affected by the residual effects of the last 12 months. The tentacles of COVID-19 have spread widely, leaving in its wake major economic and socio-economic challenges. As I've mentioned in presentations over the course of the year, FY21 has been the year that saw significant levels of tenant support needing to be provided by landlords. The months of April to September 2020 were by far the toughest on the economy and the South African people. Innovative asset and property management initiatives had to be deployed by our teams across the business as new strategies and new ways of thinking were required to navigate this complex trading environment. Business continuity remained our mission at all times. The execution of our high road scenario demanded focus and determination, which has since inception been one of the hallmarks of our business. The result was that Spear maintained its income statement and occupancy consistency in line with its high road operating strategy during FY21. The presentation today is a combination of Spear's entrepreneurial flair, focus, and proactive management approach to our business. The Spear portfolio is underpinned by high quality tenancies and assets that are well located and sectorally defensive. I wish to also acknowledge today and thank our Chairman, Mr. Abavaracia, and our Board of Directors for their guidance, consistency, professionalism and wisdom during an extremely challenging year. If there are any questions that come up during the course of the presentation, please email them to info@spearprop.co.za. We will answer them straight after the presentation. Just having a look at what I will be covering today in the presentation. So moving on to the environmental update. Trading conditions have started to show marginal improvement across the board, with a notable exception being the hospitality sector. The latter remains heavily reliant on international inbound tourism, but as a team, we have focused our energy on the local market to drive revenue. With economic activity returning, so has disposable income in certain regards, with increased customer activity across Spear's convenience retail and mixed-use assets. Return to work by office users has been slower than anticipated, yet it is happening. We believe that the reasons for the slower return to work, in our view, are health and safety concerns given the relatively slow rollout of vaccines. And as more and more people become vaccinated, we believe that the return to work momentum will increase. Furthermore, with the disjointed academic year for government schools has further complicated the return to work program for many. The tourism, hospitality and services sector remains most negatively impacted, with the lack of international tourists and curfews limiting the ability of these sectors to commence their road to recovery. The vaccine rollout has brought optimism to many, but the rollout speed has brought about frustration. We predict a more meaningful economic recovery once the rollout is in full swing and efficacies are at higher levels. Regardless of the current circumstances, the management team and respective hospitality managers have designed and developed attractive localized hospitality and conference packages as a means to generate revenue. The effects of this will be shown in the hospitality sectoral performance slide further on in the presentation. Spear has maintained its status as a stable business with a focused approach to real estate. The portfolio has remained resilient, underscoring the deep value proposition that the Spear portfolio offers shareholders and investors. Spear's regional focus has allowed us to deploy all our energy and attention on the speedy finalization of various forms of relief to impact the tenants and to focus on Spear's future. Vacancy creep has set in certain parts of the office portfolio. However, it's our opinion that this is a shorter-term challenge. The vaccine rollout with health and safety compliant workspaces will be an important contributor to this recovery. Spear's industrial portfolio has shown exceptional resilience during the year with consistent tenant demand. And in an environment where sector-wide vacancy creep has set in, we are very proud of how Spear has maintained a robust occupancy rate of 93.84% for FY21. Just having a look at some strategic imperatives. No matter the circumstances, no matter the effort, we will remain true to our North Star, which is to be a consistent dividend-paying income fund, a regional-focused investor operating with a strong balance sheet and delivering on our mission statement, which is to be the leading Western Cape-focused REIT and to consistently grow our distribution per share ahead of inflation and within the top quartile of our peer group. Now, just to recap, in May 2020, as the COVID-19 pandemic was developing on our shores, decisive action had to be taken and a three-part scenario plan was presented to the market. A low road, mid road and high road scenario plan. The low road would be Spear breaking even at a 60% rental recovery rate. The mid road would be a 61% to 78% recovery, where Spear would be generating positive cash flows, covering all its expenses plus interest, etc. And then a high road scenario, which should be 80% and above, where Spear would be profitable, covering all its expenses, including bank interest, and accruing towards a dividend. Spear has for the FY21 year achieved the high road operating scenario plan throughout the year. Our approach to FY21 was that every resource was scarce and we had to make sure we deployed capital wisely and defended the income statement and balance sheet. What strategic objectives have we achieved? We have successfully adapted to the COVID-19 operating environment. We have preserved capital and liquidity, and we have done so efficiently through the year, making the business even more resilient. There's been income statement consistency within the high road scenario. We've had strong results in our letting activity during the year across all asset types. We've maintained a very high tenant retention rate in the context of the pandemic, and even outside of the pandemic, to have a close on 6% vacancy rate is admirable. Our debtors book has remained under control, with a consistent reduction of the age analysis. We've reduced controllable expenditure Group-wide payroll and fee reductions were implemented, which you'll see coming through in the ratios a little bit later on in the presentation. Our earmark asset disposal program is in progress and gaining momentum. Now, looking beyond the short term into the medium and long term, Spear will remain a regionally focused REIT, resolved to operate in alignment with its mission statement and to continue to build a high-quality portfolio underpinned by strong tenant covenants. It's far less for us about size and far more about quality. Spear will be an impact investor, creating change both from an economic and socio-economic perspective. There will be a very strategic narrowing of asset ownership to commercial, convenience retail, and industrial investments, providing fixed income and growing cash flows to the underlying portfolio. We will maintain a distribution payout ratio of no less than 80%, and we'll continue to prudently recycle capital through our earmarked disposals. We will continue to weave renewable energy solutions into the fabric of our business and investment approach. We will reduce our gearing in line with our strategy to between 38% to 43% over the next 18 to 24 months. We will maintain a conservative debt hedged profile, on average between 60 and 75% debt hedged at any given time. We will maintain high portfolio occupancy rates through our hands-on approach and our active asset management approach. And we will remain compliant with the SA REIT legislation. So having a look at the impact of COVID-19 on Spear, there were very few places to hide from the impact of COVID-19. As a management team, we focused on what we could control and manage the outcomes as best possible. Spear's rapid response, engagement, and interventions mitigated some of the devastating effects of the pandemic on Spear. This is evidenced in today's presentation. Our regional and simplistic approaches allowed us to remain solely focused on one region and dedicate all our time and resources to the Western Cape, allowing us to zone in on solving challenges effectively and speedily as they emerged. We've remained entrepreneurial and have taken advantage of a very fluid trading environment, for instance, offering quarantine facilities, repatriation services, in addition to short-term commercial office solutions for companies requiring additional social distancing. So having a look at the FY21 operating scenario, as stated earlier, we have achieved our high road operating scenario, which was set out in May 2020. Even though challenging market conditions persist, 86% of our total rental budget, which we set in December 2019, taking no COVID into account, was achieved at 86%. Spear remains profitable and consistently operating in the high road scenario, which was set in May 2020. The balance sheet and income statement remain consistent and meeting all covenants. Liquidity availability has remained consistent to absorb various rental credits and deferrals, in addition covering all operating costs and interest. There have been no going concern risks. We have 170 million rands of cash availability, and 85 million rands of gross debt was settled during FY21. Spear's funders remain fully aligned with the business's strategy, and the company remains sufficiently capitalized to meet all short and long-term commitments. Our renewals and relet program has been on target. We've successfully passed all solvency and liquidity tests, and again, we've achieved the high road operating environment during the year. So moving on to our salient details, we'll look at the portfolio snapshot. Spear owns 32 high-quality Western Cape-only assets, with a portfolio value of 4.5 billion rand. Asset value growth compared to FY20 was 7.46%. Our average property value has increased to 139 million rand per property from roughly 128 million rand per property. Our average property valuation per square meter is 9,816 rand per square meter on a fully diversified portfolio. Our average in-force escalations was 6.81%. Escalation rates have come under consistent pressure, but as I've said previously, I would rather take a slightly lower escalation rate than sit with a stubborn vacancy. Portfolio GLA at Feb 2021 was 453,458 square meters, of which 54% is industrial, 31% commercial, 9% retail, and 6% hospitality. Our portfolio tenant retention rate was just under 94%. Our asset management team must be commended for this level of portfolio occupancy in the context of the pandemic. Our weighted lease expiry profile was 27 months. Rent and tenant retention and preservation in the short, medium, and long term is our core focus. Management makes a concerted effort to push out the well as far as possible. However, under the current trading environment, our tenants have had a reluctance in certain instances to commit for the longer term, as the operating environment remains challenging and to a certain degree unknown. However, as mentioned in prior presentations, there must be flexibility, but we are also seeing that some tenants are signing for even longer terms for between 7 and 10 years. Management has set an internal target of an average weighted lease expiry profile of between 36 and 45 months. Our average rental per square meter on the portfolio is R96.23 gross. And one of the most important metrics for me and the team for FY21 was that our FY21 collections was 97.79% of rental billed was collected, and compared to the budget set in December 2019, 86.06%. So looking at our financial metrics, the final FY21 distributable income per share, or DIPS, amounted to 73.38 cents per share. Spear's final distribution per share, or DPS, for the 6 months ending Feb 21 is 29.36 cents, resulting in a full year distribution per share of 58.70 cents, which is based upon an 80% payout ratio. As mentioned earlier, a minimum of 80% payout ratio will be maintained as we balance the cash retention and tax outcomes prudently. However, this isn't to say that the payout ratio won't be adjusted upwards in time as the trading environment stabilizes. Spear's SA REIT cost-to-income ratio for the year was 39.82%, dropping below 40% per our internal targets. Now, this is higher than previously reported, purely due to the fact that historically we reported on a net cost-to-income ratio. Now, in line with the SA REIT BPR, we report on a gross cost-to-income ratio. In addition to there not being any income forecasted or received, very little, on our hospitality portfolio, together with a shorter-term increase in costs as a result of the COVID-19 operating environment due to various forms of cash flow relief, deferments, credits, bad debt provisions, and other health and safety costs having to be incurred during the time. Spear's SA REIT administration cost-to-income ratio was at 5.48%, and this has been dropping on a consistent basis. Aggressive cost-cutting and payroll sacrifices were made during the year to strengthen the cash position of the business and push the business towards operating in the high road scenario. Spear's tangible net asset value per share was R11.50 pre-distribution, which is a decline of 5.51%, decrease in TNE from the prior year. Our tangible net asset value net of distribution is R11.21 per share. Spear's LTV at year-end was 45.81%, which is lower than the guidance provided in our pre-close presentation, which was closer to 46%. Spear's fixed debt ratio is at 56.52%. This is slightly lower than our internal range of between 60 to 75% of debt hedged at any given time across the portfolio. However, the sub-ranged hedged position is short-term, but these expiries have created interim non-rental tailwinds for Spear. We are constantly watching the FRA curve whilst taking advantage of the low interest rate environment in South Africa. The average debt expiry is 28 months. This has increased from our pre-close, which was 22 months, with no refinancing risk and in excess of 1.3 billion rand renewed and extended during the year. Spear's average cost of debt, 7.26%. Spear's average cost of variable debt, 5.66%. And our average cost of fixed debt, 8.6%, compared to the pre-close, which was 8.72%, as more expensive hedges have expired towards the end of the financial year. Moving on to our collections, Spear's active portfolio engagement and business continuity approach has resulted in our ability to report the following FY21 rental collection figures and percentages. Spear's FY21 collections are largely in line with management's high road scenario. Billings reflect revenue after all credits, deferrals, and includes recoveries but excludes VAT. Original budget reflects pre-COVID forecasting operating revenue inclusive of normalised hospitality income and recoveries set in December 2019. Arrears as at 28 Feb was 17.5 million inclusive of VAT, but has reduced by 4.7 million rand to 12.8 million at last measurement date, which was the 30th of April 2021. Having a look at the schedule, you'll see that our original budget forecasted revenue of 570.8 million. We billed 502 million and collected 491 million, which translates to our high road scenario of 97.79% collections. Looking at some more granular detail on the exclusions, credits and deferrals. As a direct result of COVID-19 pandemic, management restructured, renegotiated or provided relief to close on 200 tenants. The ongoing tenant relief has halted as tenants are able to trade and operate from their leased premises. As noted in the pre-close, the second wave did result in isolated relief requests which were considered on a triage basis. Having a look at the schedule, you will see that hospitality, we provided, there was no income of 28 million. In terms of credits provided, 16 million. In terms of deferrals, 7 million. Vacancies, 12.4. Stop billing of 12.1. And a positive income flow of solar payments of around 5 million rand. It's moving on to our financial performance. Group revenue was 531 million. Our property operating and management expenses came in at 160 million rand. Our admin expenses came in at 26 million rand, which are predominantly made up of items like payroll, board fees, general bad debt provisions, head office overheads, memberships, audit and accounting fees, etc. Our net property operating profit, 343 million. Non-cash deductions of 213 million, of which the fair value adjustments made up the lion's share of around 106 million deduction. Our net interest cost was 147 million rand for the year, with a pre-tax profit of 65 million, less our taxation, was a profit for the period of 56 million rand. Attributable to Spear was 53 million rand after the deduction of the non-controlling interest portion. After applying the 80% payout ratio, it reconciles to a 58.70 cents distribution per share and a interest cover ratio of 2.11 times. Just to note on the ICR, this will increase post the implementation and the commencement of the new lease agreement over 15 and Orange from the 1st of September. Having a look at some of the like-for-like stats, our like-for-like income is down by 6.98% compared to the prior year. Our like-for-like property operating expenditure is down 2.59%. This is a positive stat showing how we aggressively cut costs during the year. And our like-for-like net property operating profit is down 9.07%. And this also, just to be clear, relates to properties owned in both periods that we are reporting on, which would exclude the acquisition of the Liberty Life building and also exclude the disposal of the 10 Mill Street property in Newlands. Having a look at the company FFO reconciliation. The SA REIT FFO per share breakdown is as follows. Following from the income statement, the statement of comprehensive income of 53 million. Then we take into account some accounting and specific adjustments where we add back the fair value adjustments, the asset impairment of 119,000, the deferred tax of 700,000, straight lining of the operating lease adjustments of 32 million, we take that out, and other adjustments for antecedent dividend of 1.2 million give us a SA REIT FFO of 129 million rand. Company specific adjustments for IFRS 2 expense for our conditional share plan and some provisional tax paid on retained earnings, which would be adding back a 19 million rand amount, results in a total FY21 distributable FFO of 148.7 million. Looking at interims, we distributed also on an 80% payout ratio, but the distributable income per share at interim period was 36.68 cents per share, and for the final period was 36.70 cents per share, giving us a distributable income per share pre-payout ratio application of 73.38 cents per share. The final payout ratio, which was approved by the board, is 80%, resulting in a 58.70 distribution per share over shares in issue of just over 205 million shares net of treasury. So moving on to the balance sheet. Spear's balance sheet is a very easy to understand simplistic balance sheet made up of total assets of 4.5 billion, total liabilities of 2.1 billion. Only 22.5% of Spear's debt portfolio is currently under current liabilities. As part of our debt portfolio management, a portion of our debt is always retained in the shorter term facilities to take advantage of pricing, as well as taking advantage of opportunity to settle any debt if we wish to do so without incurring very expensive breakage costs. Shares in issue over the period that we're reporting on, 205,776,521 net of treasury, and 205,773,231, apologies, and our gearing ratio of 45.81. At year end, Spear's LTV of 45.36 is on the upper band of the management's LTV strategy, but we have a clear plan. An LTV reduction roadmap has been put in place as previously discussed in presentations to reduce Spear's LTV through the disposal of earmarked assets. The latter includes Spear's 2 hospitality assets, along with other portfolio assets that are considered non-core going forward. Just a reminder that, as announced on SENS, we have entered into a fixed call option for the disposal of 15 and Orange at 265 million rand to the new tenant within a period of 24 months. The roadmap plans to, over the next 24 months, reduce Spear's LTV to between 38 and 43%. So moving on to the TNAV bridge. The tangible net asset value per share at Feb 2020 was 12.17 rand. There were some adjustments made for profit for the year, excluding fair value adjustments, adding 77 cents, and the DPS that we paid in June and November 2020 reduced that by 74 cents. Fair value adjustments that came through in the portfolio reduced it further by 52 cents. The cash retained from the dividend reinvestment program at interims increased it by 16 cents. Treasury shares acquired during the period by the company within our authority reduced it by 40 cents. IFRS 2 expense increased it by 0.06 cents. Our TNAV per share at Feb 2021, as stated earlier, was 11.50 rand, and a FY21 final DPS payment of around 29 cents, resulting in a SA REIT TNAV at Feb 21 of 11.21 rand. So having a look at our funding. Over the last 12 months, our CFO and I have been working very closely with our funders given the volatility of the last year. I've been extremely impressed with the readiness, engagement and pragmatism applied by our funders Nedbank CIB and Standard Bank Real Estate Finance. I would furthermore like to take this opportunity to recognise the key role our CFO Christian Barnard played during the year. On his watch, Spear successfully reduced our average cost of debt by 149 basis points to 7.26%, together with refinancing and other funding arrangements to the value of 1.3 billion rand on improved margins, better than what they expired at. Our total gross debt is 2.1 billion rand, with 1.2 billion of our total debt portfolio being fixed at a weighted average cost of 8.66%, symbolising 56.5% of our total debt for an average period of 19 months. Just under 1 billion rand of our debt is floating, which symbolises about 43.5% of our total debt portfolio at a weighted average cost of 5.66% for a period of approximately 30 months. From our perspective, we don't see any refinancing risk across the portfolio, and we will maintain a robust and well-spread debt book over the coming years. As you can see on the slide on your right-hand side, a very mature composition of the debt portfolio, well spread out and well managed. Just having a look at portfolio funding covenants. Management took a proactive approach with our funders to ensure that Spear had enhanced optionality, headroom, and flexibility to operate through the pandemic period without any potential covenant risks or distractions. Management reached agreement with our funders to relax Spear's strictest bank covenants for the FY21 and FY22 measurement period as follows. Spear's strictest covenant used to be 50% loan to value and 2 times interest cover ratio. Management has agreed with its funders that those ratios and covenants would be pushed out to a 55% LTV covenant as a strictest covenant, and its strictest ICR would be 1.75 times. Where are we currently? We are at a 45.81% LTV and a 2.11 times ICR. So there is a lot of daylight between group covenants and where we are currently. And just again to note, the positive impacts of the fixed lease income on 15 and Orange will come through not only in earnings, but will also come through in improved interest cover ratios. Now, the above relaxation again reinforces the alignment of our funders to our operating strategy. So moving on to our portfolio overview. These are the picture here is Spear's top 5 assets. The total value of 2.05 billion, 177,700 square meters of the 453,000 square meters, making up 39.19% of our GLA. The Spear's top 5 assets by value are not only incredible assets for the eye to behold, but have added income stability and balance sheet enhancement to the already high quality nature of the underlying asset base. The slide displays the level of high quality diversification in the portfolio across asset types. It further follows Spear's less is more approach, as the top 5 assets, as I mentioned, make up a substantial portion of the portfolio. It's our firm intention and strategy to own fewer assets, but assets of higher value, which really allows us to zone in on the asset management opportunities on every single property to enhance income. 4 of the top 5 assets are all valued at over 400 million rand per property. Another key metric to point out is that all 5 of these assets are conservatively valued, well below the replacement cost, and the rentals are not over market. The location of these assets are in very sought after locations within Cape Town. Having a look at the sectoral split of the portfolio, very defensively split and by value, by revenue, and by GLA. By value, 50% of the value of the portfolio is commercial, 26% of the value of the portfolio is industrial, and 14% of the value of the portfolio is retail, 9% hospitality, and 1% development land. In terms of revenue, 48% of the portfolio revenue is generated from the commercial portfolio, 33% from industrial, 16% from retail, and 3% from hospitality. In terms of GLA, 54% of the portfolio is industrial, 31% commercial, 9% retail, and 6% hospitality. Same we look at letting activity for the period. We report a negative rental reversion on the portfolio of 3.70%. Now, under the circumstances, the negative rental reversions have been mitigated as best possible. During the year, 205,000 square meters of leases came up for renewal and relet. The management team have successfully renewed and relet 187,000 square meters. And for me, I would like to extend my congratulations to the asset management team under the circumstances within the context of a pandemic. I think they've done exceptionally well. Furthermore, during the period, which we'll talk to in our development slides a little bit later on, we managed to renew a 14,000 square meter lease with Nampak, and we also signed a development lease for similar size space with Grindrod Logistics. Having a look at our tenant and vacancy profile. Currently, Spear has 27,000 square meters of vacancy across the portfolio, which is 6.16% vacancy rate. The lion's share of these vacancies are in the commercial portfolio, which has been something that was a direct result of COVID-19. About 5,800 in industrial, 3,300 in retail, and 240 square meters under hospitality. I'm, however, pleased to report that currently, as we speak, about 3,000 square meters of commercial inquiries are under negotiation and under discussion. And what has come through quite evidently post the pandemic period is that new tenants entering the market for rental properties are taking substantially longer to make decisions as to how much space they take, how much they pay, and how long a lease they'll be signing. In terms of looking at GLA versus occupied space, so as we stand right now, 425,000 square meters of space is occupied across the portfolio of 453,000 square meters, and Spear has 395 tenants within the portfolio, comprised of 24% being large nationals, international companies and listed companies, 62% being national tenants, smaller listed entities, and 14% other, which is predominantly your entrepreneurial businesses, businesses that are either owner-managed, etc., making up 14% of the total portfolio. So having a look at our lease expiry profile, notably, our average expiries over the years has decreased from roughly 18% annually to 14%, and this is again just a testament to the quality of our asset management team, where they've managed to continuously push out these expiries and renewal periods as much as possible. So moving on to our valuations. Spear saw a decline in property valuations of around 2.57% for FY21, which is roughly 106 million rand. A conservative valuation approach has always been adopted on the Spear portfolio, coupled with our transparent disclosures to the market on a valuation and cap rate per property basis. As required by the JSE, management undertook its portfolio valuations for the FY21 year on the basis that 1/3 of the portfolio would be externally independently valued, with the full portfolio having been externally independently valued every 36 months. Properties were valued using a 5-year discounted cash flow method, and with ample provision made for bad debt provisions, vacancy periods, installation allowances, together with an adjustment to the rental growth rates, as well as prudent provisions in the expense growth rates. Having a look at the slide in front of you, you'll see that on a portfolio basis, the average discount rate applied was 13.95%. The average exit capitalization rate was 9.25%, which is an increase from the prior year of 0.36%. You will see that we have also provided only a 5% growth rate on rentals, a 7% growth rate on expenses, together with structural vacancy periods as well as void periods. When looking a little bit further down in the slide, you will see that we've segmented per asset type our valuation, average valuation per property. On industrial, 115 million rand. On commercial, 159 million rand. On retail, 104 million rand. On hospitality, 219 million rand, giving us an average property valuation of 139.1 million rand. And again, when you translate that into an average rate per square meter, you can again see when you benchmark Spear's portfolio valuations to some of our peers, you will see that they are either on the benchmark with sectorally specific or slightly below. Each property analysed has obviously been analysed in terms of its quality, its location, the strength of its covenants, and the lease term, taking into account the COVID-19 operating environment. We've adopted a conservative approach to our valuations, as well as increasing the capitalization rates by between 0.25 and 1%. The average exit capitalization rate has increased by 0.29%, with an industrial increasing by 0.3, commercial by 0.36, and retail by 0.12. As mentioned earlier, further prudent provisions have been made in the valuation methodology. Sorry, just to go one back there. Some other noteworthy points which I may have made earlier, which I just would like to underscore on this slide, is that 54% of the portfolio comprises of industrial assets, which has proven to be a strong moat around our business during the year. Consistent cash flows have been generated with ongoing demand for industrial rental opportunities within our portfolio. Spear's retail investments are both classified as convenience retail, comprising 9% of our GLA. Very limited COVID-19 impact has been felt on these retail assets, as the bulk of our retail tenants were permitted to trade from level 4 onwards. Spear's commercial assets do make up 30% of our GLA and are all located in very sought-after nodes, and for the most part have operated with very strong contractual rental profiles and weighted average lease expiries. Strong letting uptake has been seen during the year on properties like 100 Fairway Close, Northgate Park and number 1 Waterhouse, together with portfolio-wide property expense ratios reducing. The current portfolio valuation has been stress tested externally and internally by qualified professional valuers and do symbolize fair value. So moving along to our sustainability update. Significant progress has been made in the execution of Spear's PV solar rollout across the portfolio. Management's approach to sustainability initiatives have been one of people, planet, and profit coexisting within the Spear ecosystem. Spear remains focused on placing less and less reliance on fossil fuel-generated electricity supply and limit the usage of potable water across the portfolio through the implementation of grey water systems, well points, boreholes, and reverse osmosis systems. A case study I wish to share with you today has been the successful design, implementation and operation of Spear's Sable Square PV solar plant and the impact it has had from an environmental, business and financial case perspective. In October 2018, Spear commissioned a 808 kilowatt plant system at Sable Square, which is a 30,000 square meter convenience retail center located within the Century City precinct. We installed 2,400 solar panels. This was a self-funded CapEx model. We furthermore installed 26 inverters, and our initial payback period on the CapEx was approximately 7 years. However, given the performance of the system, that has now been reduced down to 6.2 years. Our first year return on investment was 15%, and an anticipated 20-year IRR is 19%. The significance of this installation, when we did the initial case study or the business case to investigate the implementation of the solar, we anticipated a 27 to 30% penetration rate on this particular property, and it points us to the direction that this penetration rate has actually been exceeded, and we are roughly at about a 35% penetration rate currently. We have furthermore, post the Energy Department's approvals, we have applied to NERSA to increase the size of this plant to a 1 megawatt plant, which would further enhance our PV performance across the portfolio and further bolster our financial case in this instance. Having a look further at our sustainability. Since the start of our PV solar journey, it's been our intention to cover as many rooftops as possible in our portfolio with PV solar, and the initial target is to achieve solar installations across at least 50% of our assets. Renewable energy has become an important investment metric when considering new acquisitions, given the penetration rate advantages, the environmental benefits, and the potential unlock of additional income streams for Spear when considering a roof rental opportunity. So how have we done so far? So of the 32 properties, we currently have 9 properties that have got solar on their roofs, which is about a 28% coverage currently. We still have 72% of our properties that we would like to install solar onto. We have generated 3,970 kilowatt hours peak of solar on our roofs, having saved in excess of 2.4 million kilograms of carbon emissions, which equates to the planting of approximately 1,000 trees. So what does the future look like? We have 10 further planned projects, which would increase our percentage of roofs covered to just under 60%, which exceeds our initial target, but we'll keep on going given the strong business case and environmental case. We will anticipate that post implementation of these 10 additional sites, that Spear will be generating 6,189 kilowatt hour peak of energy from our solar installations across the portfolio. And the graph on the left-hand side, the orange bar is effectively the power generation during 2016 as an example. The blue is the total power used on our roofs and or total power used on our portfolio. And the green is the power generated from or utilized from municipality, with the red the power generated from our solar. And you can see that we've indicated where lockdowns commenced. You'll see a dramatic drop in the performance of our systems. However, you'll see towards November, the system in the red line starts to peak up substantially. Having a look at our sectoral performance. So the resilience of the Spear portfolio has been displayed in the level of collection set out earlier in the presentation, along with the below sectoral performance update. Having a look at our retail performance, all our retail assets, as I've mentioned, are classified as convenience. This subsector has proven to be very resilient during this time and has probably posed the strongest recovery. Our retail portfolio occupancy was at 91.66%. Our collections have been at 95.55% versus revenue billed for the period. Spear provided credits and deferments to retail tenants to the following values: 7.8 million in credits and R500,000 in deferments. During all levels of lockdown, our retail assets have performed in line with expectation, with all anchor tenants operating under level 5 onwards. Letting activity was in line with our expectation, with the bulk of our renewals being concluded per our forecast. We haven't had any significant retail tenant failures occurring during the interim period. However, Spear had elected not to raise rental on some of our gyms, which we have 2 within the portfolio, as even as lockdown levels had eased over the last year, the return to gyms has been a lot slower, and unfortunately the cancellation of membership rate has accelerated. We have had, however, very encouraging tenant feedback across the portfolio in terms of trading conditions, specifically because our retail centres are open air centres and the footfall has increased, and they are not mechanically ventilated or mechanically cooled, thus making it quite conducive to a very strong social distance environment. What are the risks? The risks are that there are lower levels of disposable income, given the fact that we are in a recessionary environment, which could have a result on tenants being able to pay their rentals. We obviously had to, as I mentioned earlier, restructure and take longer term views on our gyms to ensure that they would survive. So having a look at our commercial portfolio. As you emerge from the pandemic environment, working from home, in our opinion, will not be a one-size-fits-all solution. Thus, office space in good areas will remain relevant. Now, the ability to empower, collaborate, promote, and transfer skills becomes very limited exclusively via a digital platform. However, landlords will have to think about the overall experience of coming into the office and how that can be made more attractive and safer from a health and safety perspective. We have already noted a strong return to work trend in parts of our portfolio, coupled with a hybrid approach, for example, 3 days in the office, 2 days remotely. Numerous companies have already implemented a return to work program, but the slow rollout of the vaccine is hampering those efforts. All of Spear's commercial assets are located in highly attractive and established nodes in Cape Town. Our office portfolio occupancy is at 86.96%. Our collections have been at 96.70% versus revenue billed for the period. Spear provided credits and deferments to office tenants to the following values: 6.8 million in credits, 3.9 million of deferments. The Spear portfolio is attractively positioned to offer expansion and/or contraction space to third-party tenants due to its attractive lease terms and generally below market asking rentals. In certain parts of the portfolio, tenants have needed to increase their premises to comply with COVID-19 social distancing requirements. Case in point, at Northgate Park, we had recently concluded an additional 1,500 square metre lease agreement with a tenant requiring additional space. In other parts of the portfolio, headwinds continue, with certain office tenants electing not to renew their leases in order to test a hybrid remote working strategy and to reduce company overheads. We do, however, not see this as a long-term trend, and once companies fall back into a rhythm of being able to return to work post-vaccinations, we would see the demand for office space increasing incrementally. The impact of the sporadic load shedding has caused tenants to also rethink their decision to work from home. All Spear's office locations are fitted with robust business continuity solutions in the form of backup power generators. Where do we see the risks? Asking rentals will soften as vacancies may rise higher than normal. Increased vacancy would result in increased competition between landlords for tenants, therefore a bidding war may erupt. Generally, the potential is high for negative rental reversions across the office sector as tenants have hold all the cards in terms of negotiation, and the cost of installation of tenants will increase. Having a look at the industrial portfolio, Spear's industrial portfolio has been resilient over the year, with several new lets and relets taking place in a very challenging environment. Spear's industrial portfolio occupancy was 97.6%. Our collections have been 97.70% versus revenue billed for the year. Spear provided credits and deferments to industrial tenants to the following values: 2.1 million in credits, 2.5 million in deferments. The second half of the year saw credits and deferments reduced due to tenants being able to operate under level 4 onwards, but some tenant failures did occur, which were speedily replaced. The vast majority of Spear's industrial tenants were able to operate under level 4 onwards. Strong demand for our industrial properties are there. We're seeing a lot of inquiries coming through from brokers, from owner-operators looking for expansion space. What are the risks? Load shedding may have a negative impact on the manufacturing tenants. Labour relations and the cost of labour, trade unions being unnegotiable on increases, increased capital requirements to maintain the quality of our industrial assets, and major market or tenant failure. So moving on to our hospitality portfolio. This is by far the sector hardest hit by the impact of COVID-19. Management had eliminated hospitality income from its FY21 forecast, as the market is aware from numerous other presentations. Looking at the DoubleTree by Hilton, which is owned and managed by Spear. Now, the industry showed slow recovery from September to mid-December, when the second wave was officially confirmed and stricter lockdown restrictions were imposed. However, 6.2 million in turnover was generated in the 6 months at a 13.2% occupancy rate and a 820 Rand average daily rate. We furthermore generated an additional 2.5 million Rands of income during level 4 lockdown through offering repatriation services. Aggressive cost cutting was being implemented and all non-essential services have been done away with. These cost cutting measures have been cemented into the post-COVID recovery plan. Our recovery forecast, based upon the initiation of the vaccine rollout and decline in active COVID-19 cases, looking at the forecast versus actual, looks as follows. In the pre-close, we did give some guidance in terms of our forecast, and you will see that the forecast showed 1.3 million of turnover. We've actually exceeded that forecast to about 1.7 million of turnover. Occupancies, we also exceeded on the forecast from 17% to 23%. However, we did sacrifice the rate for occupancy and for rooms sold. Again, March 2021, April 2021, we exceeded our forecast, and we are confident, with the exception of a severe third wave, that this positive momentum will be maintained. Having a look at 15 on Orange, as announced on SENS on the 18th of March, management had entered into a fixed income lease with the Capital Hotels and Apartment Group. This lease effectively replaced a variable turnover lease with another international hotel group with a fixed income lease of which Spear would start to earn rental from the 1st of September. The market would take into account that for the FY21 year, we only received 1.8 million rands in rental from the hospitality portfolio, mostly pertaining to Jan 2020 and March 2020 prior to the lockdown. The significance of the fixed lease agreement with the Capital Group will increase our rental income from an annualized amount of 1.8 million for the 2021 year to a monthly net rental of 1.6 million rand from the 1st of September. Now, the fixed income lease not only reduces Spear's exposure to variable income, but has a significant and restorative impact on group earnings, which I will show you in the following case study. Having a look at the bottom schedule, the hotel rental for 2021 was 1.8 million. For the 6 months of 2022, which given the fact that the lease commences on the 1st of September 2021, will be 9.6 million rand. The contribution to the DIPS for this particular property will be 4.67 cents. So the contribution goes from 0.87 cents to 4.67 cents. And the increase to group DIPS will be 3.79 cents versus a zero contribution to group for FY21. Followed by FY23, when looking at it in a full year context, the full year rental received will be 19.2 million. The 15 and orange DIPS contribution on a per property basis will be 9.33 cents, and on a group basis for FY23 will be 4.67 cents. Now, this schedule only shows the effect of the lease on 15 and orange. It doesn't take into account the remainder of the Spear portfolio, where, as you've seen, with the high occupancy rate, with an in-force escalation in excess of 6%, we believe that there is going to be, even amidst a tough trading environment, there is going to be earnings enhancement, and stability of the underlying portfolio will show consistent growth in DPS going forward. Now, there are risks. The business market might not be able to travel as much as possible internationally, making us more and more reliant on local business market. The meetings incentives market will probably not want to meet in larger groups. And then there would be the prolonged finalization of the COVID-19 vaccination rollout, which would also have an impact on the hospitality and services sector. So moving on to a general business update. So the general trading conditions remain tough, with early signs of increased demand for Spear's rental properties. The industrial and retail sector showing the most resilience, with strong rental demand. As mentioned, office sector vacancy creep has set in, with a slowdown in demand for rental properties across the sector. The Cape Town CBD, in our view, has taken probably the most of the pressure, and with our northern suburbs and Century City portfolio operating positively. Positive signs have emerged in the hospitality portfolio as rooms, conference space and meeting space bookings have picked up. For instance, in this week alone, we achieved a between 35 and 50% occupancy rate at the Doubletree by Hilton. The fixed income lease concluded for 15 on Orange will be effective the 1st of September 2021. Our collections remain firmly in line with management's high road scenario plan, and our balance sheet remains robust. The debtors book management has been tough, but it's on target and consistently reducing. Our asset disposal and LTV reduction program is ongoing and in line with our stated strategy. Our renewals program is in line with our forecast, and the Grindrod industrial redevelopment has been successfully concluded on time and on budget, which I will talk to shortly in the presentation. So during the FY21 year, Spear undertook 2 portfolio improvement projects off the back of 2 blue chip long-term lease agreements totaling 78.4 million rand in capex. The one project was a redevelopment of an industrial warehouse with an extremely large yard to a container terminal and shipping industry related bulk storage facility. What makes this deal significant and why we were the right jockeys was effectively that Spear, being an internally managed fund, also is internally responsible for its own development management. Spear as a team, we had applied to the City of Cape Town to have the property's use amended. We went through the entire land use management process. We got the relevant departures approved. We development managed the entire process from start to finish and delivered a product to Grindrod Logistics off the back of a new 10-year lease. Now, from our perspective, this again is indicative of our entrepreneurial approach to real estate. We didn't just take the position like, okay, our tenant has moved out, now we need to just go through the normal course of trying to find a tenant. We looked at our zoning rights, we looked at what we can unlock on the property, we looked at what our pivot opportunities were, and this opportunity presented itself, and we took hold of it with both hands. And this has resulted in long-term cash flows and sustainable cash flows with the blue chip tenants, further underpinning the quality of Spear's industrial portfolio. The second project we undertook was for one of our long-standing tenants, Nampak Limited. The division occupying the existing 12,500 square meter facility required additional bulk warehousing space to increase their manufacturing capacity in other areas within the property. The location of the property, the availability to expand on the land, and Spear's ability to expand the tenant's floor area whilst they operate resulted in the conclusion of a long-term lease agreement with Nampak to unlock the additional revenue stream through the extension of the 2,000 square meters of warehousing on the site. What you see is also that you'll see the blue box on the right-hand side, and the white box on the right-hand side, and the white box in the further distance behind, and then you'll see a grey roof. So that entire grey roof is being replaced with a new clip lock roof system, together with a state-of-the-art PV solar system, given the fact that not only do Nampak distribute from this facility, but they also manufacture from this facility. Then our ambitious Marine Place project. Just an update on this project. Spear has successfully rezoned all of the sites that will be consolidated to form part of the Marine Place development. Our time horizon on this project has been pushed out by at least another 4 or 5 years, given the impact of the pandemic. But it's notable that all the sites that form part of this future development project are 100% let, yielding, and are not creating any drag on our income, given the fact that the properties, we added the value through the rezoning process. We did not acquire these properties at their total development bulk valuations. Looking forward into the future, Spear will most likely seek a strategic partner to co-develop the site with us in the fullness of time. And we believe that this project will add significant value to the real estate environment in Pardon Island, with in excess of 600 residential units, 10,000 square meters of office space, and 12,500 square meters of convenience retail areas located in extremely close proximity to the CBD, as well as located on all main arterial routes leading from the N1, the N7, as well as the M5. So moving on to our outlook. So the macroeconomic conditions will remain difficult to navigate as the global and local economy adjust to the impact of the last year. Spear's core portfolio remains high quality and defensive. The lack of international travel and associated restrictions will continue to negatively impact the general services, hospitality sector, making the recovery in that part of the portfolio slightly slower. The restorative nature of the new lease agreement on 15 on Orange will positively impact group earnings from the second half of FY22 and will further improve the group's interest cover ratios. Our commercial offices will, in the short term, trend upwards in terms of vacancies, with office vacancies normalising in the medium term as return to work plans are initiated. Spear's industrial and retail portfolio will continue to trade strongly through the economic recovery and post-pandemic environment. We as a management team will remain client-centric, and we will focus on sustainable cash flow solutions for our businesses. and our proximity to our assets will always remain excellent. We will continue to actively dispose earmarked assets within the portfolio in line with our strategy. The portfolio will continue to display resilience and fortitude as it has done over the last year. We have since inception maintained a high occupancy rate, and it is our firm intention to do so going forward. We will also focus intently on restoring income to those parts of the portfolio most deeply impacted by the pandemic. We will ensure that all health and safety measures and protocols are maintained and sustained across the portfolio. We will prudently steward capital and the allocation of capital as the business remains well capitalized and meeting all of its covenants. And as a board and as a management team, we remain significantly invested in the company, displaying clear shareholder alignment. Our operating platform remains robust and will continue to underpin the quality of our business. We will ensure that we focus in the year ahead to deliver a mission statement aligned return to our shareholders. And our hands-on asset management and tenant-centric approach will remain key to our operating strategy going forward. We will continue to endeavour to execute our LTV reduction roadmap over the next 18 to 24 months with a targeted LTV of 38 to 43%. So having a look at our guidance. Now, it remains difficult to fully predict the longer-term economic effect of the pandemic and what it will have on the broader real estate sector. Given the benefit of hindsight, we can see that the hospitality and commercial office sectors have been deeply impacted. Now, given the marginal improvements in the trading environment, as retail footfall has improved, the general inquiries for rental properties have improved, we believe that our portfolio is well positioned to navigate this time. Our rental recoveries have been maintained within management's high road scenario. Our receivables are under control and are reducing on a consistent basis, further improving our liquidity. We will maintain our Western Cape only focus, a key attribute which has influenced our strong rental collections during the past year. We will continue to focus on creating additional momentum on the disposal of non-core assets in line with the LTV reduction roadmap. And navigating into FY22, the trading conditions and the economic outlook in South Africa, and Spear's case, the Western Cape, is suboptimal, but we will do our part to ensure that we adopt a cautious approach, but also an approach that is one as a contributor as opposed to just a consumer to the economic activity in the Western Cape. We will also ensure that, although we can't fully predict what the year will hold, we will ensure that we give you our best. Now, our guidance for FY22 will be a distribution per share growth of 6 to 8%. Spear's payout ratio will be maintained to be no less than 80% of distributable income per share. Again, this guidance is on the following assumptions: that the ongoing recovery of the macroeconomic environment will continue, that no third or fourth wave of infections will hit South Africa, followed by a lockdown. Lease renewals are concluded per the company forecast. No major tenant failures occur during the year. Tenants are able to successfully absorb the rising costs associated with deferral repayments, utility consumption, and municipal rates. The trading environment vastly improves with international travel markets being able to re-enter South Africa post the vaccination rollout. Ongoing load shedding remains at low stage levels, and a successful rollout of the COVID-19 vaccine. Now, obviously, any change to any of the above assumptions may also impact our forecast. Management focus will remain on its core portfolio, on its core business, which is to let space, retain tenants, manage our expenses, and grow our income as best possible within a very tough trading environment. As a management team, we will remain as accessible as ever with regular updates to the market as Spear progresses through FY22. Thank you for watching. This brings us to the end of our presentation. We will be back with you shortly for a question and answer session. Thank you very much. Welcome back to the FY21 results presentation Q&A session. With me is my esteemed colleague, CFO Christian Barnard. Christian and I will be answering some questions that came in during the presentation. I will just ask Kim to maybe just start with the first question.
Sure, thanks Quintin. The first question is from Primrose Investments. Well done on the Grindrod redevelopment and long-term lease. Can we expect similar value unlocks in other parts of the portfolio?
Thanks, Kim. As a management team, we're always looking to unlock value across the portfolio. And maybe one thing that I did not mention was that in addition to the existing 453,000 square meters of GLA that Spear owns, we probably have an additional 150,000 square meters of undeveloped but developable bulk available on the portfolio. And yes, the answer to that question is we do have other opportunities to replicate similar redevelopments or similar pivots. And as we speak right now, we are actually looking at that exact type of scenario with one of our existing tenants that's growing from 2,500 square meters to approximately 6,000 square meters. So watch this space.
Thank you. The second question is from Diaspora Holdings. Well done on the solid results in such a tough environment. Is an 80% payout ratio the new normal for Spear? Christian.
Obviously we've applied an 80% payout ratio for the current financial year, but it will be the new normal to have a reduced payout ratio, but 80% will not be a one-size-fits-all. It will be reviewed every distribution period. It will be reviewed based on liquidity availability, in terms of what we can afford in terms of assessed losses, what we have to pay in terms of the tax, to the income tax. So it will be analysed, and if we can increase it to 90 or 95%, it will certainly be done.
Thank you. We have a question from Peter at Acurus for Quintin. There have been some signs of consolidation in the listed property sector. To what extent could Spear look at M&A opportunities?
Thanks, Kim. I think the potential for consolidation in the sector is still exactly what that is, potential. There's talk of it, but from Spear's perspective, Spear is a very focused business. So we have a regional approach. We typically have no desire to own assets outside of the Western Cape. The furthest offshore we'll go, as I said in the past, is Robben Island. And given the fact that a lot of the other of our peers in the sector are invested either across different regions within South Africa or have a weightiness of assets offshore, we don't necessarily see any potential synergies. But again, we always look at opportunities and see. And again, as those opportunities present themselves, we have a formal investment committee structure that considers all opportunities. But right now, there's absolutely no consideration for M&A activity from a Spear perspective.
Peter's second question. Could an equity raise form part of Spear's roadmap to reduce LTV to the 38 to 43% range?
Yeah, I guess, the very nature of REIT is to raise capital, and at the right time, at the right price. This is definitely something that's one of the tools within our toolbox of our roadmap. But as we look right now, the strategy is to dispose of the hospitality assets as well as the earmarked assets within the portfolio. And as and when the share price is conducive to some sort of a raise and the weighted average cost of capital consideration on acquisitions is conducive to the raise, we'll consider it. But at this moment in time, there's no consideration currently.
Thank you. A question from Simon at White Boxing SA. Does Spear undertake any external valuations? Christian.
Yes, we certainly do. Obviously, per the JSE requirements, you are permitted to, at every year, you have to do 1/3 of your properties by external valuer, which we do by Molson at Magnus Penny. And we do at a minimum 1/3 a year, but we do look at a 1/3 rotation basis. So some years it's slightly more than 1/3, and other years it's on 1/3, but we certainly have done so. And then, just for clarification, our internal management valuations is done by a accredited valuer who has the knowledge and skills of 15 years valuations. It's done by an internal person.
Thank you. There's a question from Alistair Anderson. Is this the first time your divvy has dropped on an FY basis since listing?
Yeah, well, I think that goes without saying. Our distribution has dropped also because we've adjusted our payout ratio. Historically, we had a 100% payout ratio, and given the effects of no income on the hospitality portfolio and the 80% payout ratio, there has been a reduction in the distributions. However, if you look at the distributable income per share number, together with the growth forecasted for FY22, we believe that we are now on a solid growth trajectory to have enhanced earnings going forward.
Thank you. There's a final question here from a comment and question from Egan Lemon. Well done. Please keep this up. Is Spear looking at other energy sources, for example, wind?
So we have taken the view, as I mentioned, that sustainability is a very important aspect of our business approach. And whether wind energy is a feasible solution in terms of alternative energy production, please get in touch with us via our website and we'll consider it. But at this point in time, the solar PV approach and the water approaches we've taken after much analysis proves to be the strongest business sustainability and finance case.
That's all.
Great, thank you very much. Those are all the questions. And just a closing comment, we know that globally the impact of COVID-19 has been devastating, and we take this opportunity to thank you for logging on today, for being consistent in your support for Spear, and also for always being available to engage. We furthermore also want to just point out that Spear will remain a focused business looking to generate consistent cash flows going forward, being a business that's easy to understand and a business that is true to its nature, which is a dividend-paying fund. Thank you very much, and God bless.
Thank you.